Good afternoon. This is a pre-recorded presentation for Sustainable Places 2020. My name is Pierre Alexandre Hughes-Daly, and I am an associate in the Infrastructure and Renewables team at NIBC Bank. NIBC is a small Dutch bank based out of The Hague. We cover Western Europe, so that is Benelux and Germany, the UK and Ireland, and the Nordics. Our activities typically revolve around corporate lending, originating from our own balance sheet, originating and managing debt portfolios for institutional investors, providing advisory, M&A, and equity or debt capital market services. And I guess as the infrastructure team, we've been very much focused on digital infrastructure for the past 4 or 5 years. So we've built a bit of a track record on that front and have seen probably most transactions in the market from the debt side anyways. Today we're going to look at digital infrastructure from the point of view of a bank or debt financier. What is digital infrastructure to us? Why is it such an interesting segment? We'll then move on to a brief market commentary, looking at the past 4 or 5 years of underlying trends shaping these segments, followed by what I hope is an interesting Financing 101 introduction to how banks look at a fiber asset, what the typical terms you would expect to see for such an asset are, and sort of how we analyze the asset itself and then the transaction sort of determine the viability of the proposition. Finally, we'll wrap up with a look at what the big trends and the big topics we see coming up covering digital infrastructure and how the segment's going to be shaped in the years to come. Communication infrastructure and data centers are at the heart of a world that is digitally transforming. As an asset class, infrastructure has changed a lot in the past 5 years. Typically, core infrastructure would have covered transport, regulated utilities, energy. Digital infrastructure didn't historically play a large part of this. This has obviously changed, and as the pandemic has highlighted, we as an economy, as a modern economy, very much rely on digital connectivity and the cloud infrastructure. So it's very much becoming, if not quite yet, a fourth utility, probably in a certain way one of the most core utilities that we have. Economies just don't function anymore without digital connectivity. In our view, digital infrastructure consists of 3 broad segments, each subdivided into their own subsectors, of course, but breaking it down, we look at fixed communication. By that, we very much mean fiber, pure fiber, so full-on end-to-end fiber connectivity from the backbone to the home or the building or the premise. Wireless communication, which can be broken down into mobile phone operating network towers in urban areas, but also the towers beaming broadband to hard-to-reach, underserved rural areas. And data centers, historically more of a real estate play, but now very much seen as part of the digital infrastructure sort of ecosystem, if you will. Why do we see it as such an interesting segment? Typically, these assets benefit from stable, predictable cash flows. In the case of data centers, before the data center is even built, typically you'll have a 5 to 7 year contracted agreement for the provision of storage and processing services. In the case of fiber or wireless communications, there's a high stickiness to the revenues once the network is built and operational. If you think about it, how often do you change your internet or wireless service provider? It's a strong growth segment, and this is important, and we'll come back to this later on. Growth very much underpins the entire investment philosophy of the sector at the moment. In the case of fiber and wireless, we are still not at a point where these networks are really generating positive EBITDA, positive revenues, as we're still very much in the capex, so that is expenditure of capital to build the network phase. And in the case of data centers, the entire segment is underpinned by a growing data consumption trend, growing cloud infrastructure, and need for further processing power in the years to come. So very much not even at the beginning, but just in the middle of the growth phase of the asset. It's a strategic niche market. Our economies are so dependent on the cloud infrastructure and the connectivity infrastructure today It's hard to sort of think how our economies would function if we just cut off the internet or the data server access in the modern economy. And I think this has been very much highlighted by COVID and the shift to flexible working and working from home in recent times. We also see this sort of shift to the strategic view of the sector just from the words of government. The British government is very supportive towards the digital infrastructure, European Commission as well, German government full backing, and this is set to continue as people realise that actually they need a solidly built, highly redundant digital network. And finally, it's a quite resilient sector. Again, COVID sort of highlights this, but more generally, once these assets are built, they will generate utility and revenue and services for many years to come. Once a fiber is in the ground, it's the dominant technology and likely to remain the dominant technology for years to come. Same with a data center. Once it's been built, you have that data storage capacity. So quite resilient assets. Looking at data center activity, as mentioned, very much underpinned by a growing data consumption and data storage requirement trend. If we look from 2016 through to 2021, we're talking about a quintupling of data storage volumes. This more rapidly, as we sort of progress forward, is being also driven by big data. Big data has been a big trend for many years, but I think we're only just sort of starting to build that steam where people know what to do with big data, and thus storage capacities are very much being driven by that. Increased storage capacity requirement means increased data centers, more data centers need to be built, So that has driven data center M&A activity. If we look at H1, H2 2015 on the graph on the right, we see 25 transactions compared to 60 transactions in the second half of 2019. And that set is very much set to continue. In the latest numbers I've seen is that in 2019, 10% of all infrastructure spending, so that's the asset class as a whole, was on telecoms. Through the first half of 2020, that has gone up to 25/30%. So a substantial shift, and we expect that to continue. If we look at this slide, this one's quite an interesting one as it sort of highlights the journey, if you will, of infrastructure going forward. If we look at October 14, in the dark blue line, we'll see that the valuations, the multiples, were about 12 times. What does that mean? Well, it means that for every euro of EBITDA that your data center was generating, people were willing to pay 12 euros to acquire it. So at that time, those multiples have evolved over time. And if we look in October 2019, and the acquisitions of pretty big transaction from Equinix and Digital Realty, those multiples are in the 20s now. And this graph ends October 19, but based on what we've seen throughout 2020, those multiples are now at sort of 25, 26 times. That's quite high. That's a lot of money being spent on your assets. This has been driven by the huge amount of liquidity that's being poured into the sector as investors look for, one, positive returns, and two, stable, safe assets, especially think of the institutional investors which need to put their money somewhere. So you do start to wonder if at 26 times you're really getting value for your asset. Again, you get 4 or 5 bidders per asset every time a transaction takes place. I think there is still value there. I wouldn't panic yet. If we look at the light blue line, we see that the leverage ratio at around just under 3 times in October 14 has steadily, but not overly quickly, creeped up to just about 4 times leverage as of 2019. I think within the scope of infrastructure assets in general, a 4 times leverage is nothing to panic at. That's roughly as expected. So quite a healthy market, a lot of activity, a lot of liquidity, and quite a lot of deals being done, which is a good sign, especially in light of COVID. I think the sector has kept on booming. So 2020 being a busy year, 2021 will probably be even busier. If we look at fixed line communication, or I will say fiber, going forward, fiber is considered to be the superior technology at the moment, especially given sort of the large bandwidth you can pass through it. But if you look at the graph on the left there, we see there's quite a disparity still in Europe in terms of coverage. So what the graph shows you is, as a proportion of the number of households within a country, how many can be served by fiber. So that's not connected, but hypothetically, how many could connect to a fiber network if they so chose to. And we see that countries such as Spain and Portugal are very much leading in that direction with rates of 80% and above. However, if we look over to the right of the graph, we see that Germany, so that's DE, and the UK and Belgium, BE, still quite far behind. As of the end 2019, I believe, UK is only just at about 10% coverage. I think we expect by the end of 2020 it'll be around 20% coverage. So there's still a large segment of the market that needs to be built. I think that leads us to see the UK and Germany especially as quite healthy markets in the years to come on the fiber side. If we look at the graph in the top right, we see, for example, in the UK, 2.8 million homes passed in 2018. That's expected to go up to 27 million by 2025. That's quite a fast growth. And that's a lot of capex. That's all going to need to be financed. So great opportunity for the banks, a lot of financing coming our way, and probably a lot of M&A activity to follow on the back of that. 2020 has been the year of fiber so far. If we look at the bottom, we see quite a few transactions have taken place this year, and also quite a variety. Not all fiber assets are the same. It's not a cookie cutter industry. If we look at Deutsche Glasfaser or Nexio, big German networks, we can see BNT, so Soccer BNT, which would be a smaller rural network in Germany. Glide, a UK asset which services mostly student accommodation and hard to serve business parks. Different niche to GigaClear, which again focuses on targeted government subsidized UK rural regions. So quite a few transactions in the fiber space this year. As we speak, we're still closing a couple more, so we expect to see a bit more activity before year end. And I think that's just setting us up for an even more active year next year in the segment. Wireless communication is an interesting one. Probably the biggest point to make on wireless communication and the advent of 5G is that 5G doesn't compete with fiber. Rather, we see them as complementary technologies in the years to come. So again, plenty of market share for everyone. From our perspective, and I guess when I talk about wireless communication, I'm not really talking about the big, huge tower networks you see across countries, serving sort of Verizon-style mobile networks. That's not necessarily the segment we as a bank play in, but we tend to look at the smaller, and if we look at point number one there, the smaller regional operators. So we've seen quite a few names pop up recently, such as Imagine, which is an Irish rural fiber provider. So that's a tower built that then beams broadband to villages and nearby properties. So enhanced mobile broadband, I think, is where it's at right now. And as I said, we're still seeing a few names in the market slowly crop up. So Airband, the Air Fiber, a couple of others, currently raising equity, I believe, and sort of seeing how that develops over time. As this segment matures, we will then move on to point 2 and point 3. So point 2 is very much as our cities become smarter, as we start developing a bigger sort of Internet of Things ecosystem, we will see that there's a much larger requirement for sort of data connectivity and data touch points. Every time you touch an app or every time you interact with a digital appliance, that signal needs to go to a data center, get processed, come back. And I think as of 2018, per capita, we interact about 1,500 times a day. That's likely to increase to an expected about 5,000 times a day by 2025. So as these ecosystems sort of settle in, we will see more wireless transactions, I think, going forward to build up that tower infrastructure. So looking, I guess, at the case study, and this is very much a fiber financing 101, probably the most important part, and this comes back to that growth point I made earlier in the presentation. CapEx is spent upfront in the case of a fiber asset, but the revenues are not generated until 3, 4, 5 years down the line. And so that disconnect between the spending and then the ability to be paid back down the line is something that we as banks need to get comfortable with and sort of understand before we finance the asset. And I think you'll see a variety of specialist financiers and the usual lenders who've been in the segment for several years now, who've gotten their heads around this interaction. What this graph shows is the penetration rate on the left and the penetration rate growing over time on the bottom. So what do we mean by this? Well, as you build your network on day one, not everyone who within reach of your network will connect on day one. You might have a small portion on day one, 3, 4, 5%, and we call that the penetration. Over time, as your network is embedded and as more people connect, your penetration rate will increase. So we see that if we look at the light blue line, cohort 1, we see that over the course of 4 or 5 years, or in this case quarters, which is how banks typically look at these things, by the time we're quarter 16, quarter 20, so that's year 4 or 5, that cohort will have grown from a 0 or 5% penetration steadily to what we see as being the cruising penetration, if you will, of 35 to 40%. And that 35 to 40% is really when that network is generating positive revenues, i.e., it's now at a point where, bottom line, it can afford to pay back the debt it's incurred to pay for the initial rollout of the network. So in cohort 1, quarter 1, you draw the debt, you build your network, you're then negative revenue over the next quarters, progressively less and less and less, until you break even, and then by the time you're sort of quarter 16 to quarter 20, so year 4 or 5, your network has reached a critical mass of subscribers where that positive revenue is being generated, and thus you have the ability to pay back your debt. But during those first 4 or 5 years, obviously, you're not paying back that debt, and I think banks spend a lot of time being comfortable about that. Another point to note is, and this makes sense when you think about it, typically operators roll out their networks in incremental stages. Cohort 1, the first network that the operator builds, will typically be quite small, 10, 20, 30,000 homes. Cohort 2, once the operator is a bit more experienced, so that's the next year's building. Cohort 1 could be 2015, cohort 2 could be 2016's growth. And that cohort will be a bit bigger. And then cohort 3 will be even bigger than that. I see it's in red, it says cohort 2, that should be cohort 3, my apologies. So that incremental increase in your network size also means that actually the majority of your revenues will be generated by a cohort 3 that is the right size down the line. And by that point, if we start at quarter number 9, by the time we get to cohort 3's cruising speed, well, it's actually probably 6 or 7 years in. So that impacts the dynamic of the financing as well. This brings us on to the fiber financing itself. What does a fiber financing look like, and how do banks get comfortable with the underlying asset? So on the left, we've got typical terms. We see a tenor of 3 to 7 years. That's the duration of the loan. We introduced the concept of availability period. This is the period during which you are drawing down on the loan and spending that money to build your network. And then the post-availability period is that, as described on the previous slide, it's that period of time after your network's been built where it's starting to generate the revenues it needs to in order to be able to pay back the loan. So we always look at these financings with that availability period concept. Availability period typically of between 3 and 5 years, with the final 1 or 2 years of the facility being the post-availability period. because you're not generating revenues during the availability period, or rather you're not generating enough to pay back your debt, as lenders, we have what we call drawdown tests, which is a way for the lenders to be able to ensure that your rollout of your network is going according to plan, fundamentally. So we look at typical tests such as debt to network size or debt to home passed. This is the total debt drawn at test time divided by the number of homes your network can notionally reach. And that gives us a pound or euro or dollar number, which is essentially how much is the additional home costing to be encompassed by your network. And we can compare that to your original forecasts or the original discussions we had when the financing was put in place, or even sector comparables to see, well, relative to what we would expect, are you deploying your capital in a reasonable and efficient way? Your debt to subscriber base, or debt to home connected, is a more granular concept, and that looks at your debt divided by the actual connected homes in your network. So it's all good building a network, but if you're building a network to empty warehouses, you're never really going to get the revenues needed to eventually pay back that loan in the first place. So that's a more granular insight into how profitable is your network, how many people are actually connected to it. And the third one, the penetration rate or minimum penetration rate, is the same concept, but over time. As we discussed, our expectation as lenders to someone building a network is that in the initial year, you'll have a relatively low penetration rate, 0, 5%, or whichever. But over time, we would expect that penetration rate to increase. So year on year, those tests increase just to ensure that everything's going according to plan, the penetrations are going up, you're connecting homes, and you're building a solid, successful network. Following the end of the availability period, we will have a more traditional financing covenant. So here we look at things like debt service ratio or interest cover ratio, and that's the revenues, or the EBITDA in this case, that you're generating, divided by the interest or the amortization, or both added together, depends on the ratio. And it basically covers your ability to pay back your debt. And that's a much more traditional banking financial covenant you will find in your documentation. You'll also find a leverage ratio covenant, typically in that post-availability period. This covers just the amount of debt you have to the amount of revenues you're generating. And obviously in day one, year one, we would expect that leverage ratio to be very, very high because you're not generating the EBITDA, the revenues you need. But over time, we would again expect that leverage ratio to decrease. And this is another way for us to monitor just how well the asset is going along. So these are covenants which, as lenders, we're not putting those in to limit or control your ability to stick to your business plan. And typically they will be sculpted or set at levels pre-agreed with yourself to give you a margin of error and an operating width to run your business. But they are important for the lenders to be able to understand, well, is the business performing according to plan? Other concepts you'll find are equity support. So this is, as a lender, we just want to ensure that the initial borrower or has some skin in the game as well. Now, what this clause typically says is that for every pound you spend on deploying your network, we as a lender will pay, 60, 70, 80% of that. The rest will be paid by what we call the equity sponsor, the owner. And that's just a way, again, for lenders to ensure that they aren't taking all the risk, but are sharing the risk with the actual business owner or operator themselves. Distribution limitations. These are clauses which come in to fundamentally limit cash exiting the business towards the shareholder. If, as a lender, we are financing a business, we want that money to be spent on building the network, We don't want that money to be distributed to the shareholders. So typically you'll find no distribution clauses during that availability period we discussed. And then as the business starts to generate the returns and the positive revenues, then those limitations are relaxed and become more borrower friendly as well. And finally, but not least, you'll look at information undertakings. And this is important because, again, during that availability period where you're in a network building stage, because there are no financial covenants, and there's no way for us as lenders to really, truly step in if things aren't going well, typically we will have information undertakings which require the business, the borrower, to, on a quarterly or semi-annual basis, share their management accounts with us, share their financial statements with us, and also give us updated budgets, amongst other things. But again, just share information for the lender to be comfortable that everything's going according to plan. And typically, when negotiating these financing documents, these will be the main topics, so availability period, drawdown tests, financial covenants, distribution limitations, information undertakings. These will all be the topics on which there's a bit of to and fro in negotiation to ensure that the banks are comfortable with the financing, but also, and this is important to remind, is that we are there to provide a lending service. So ensure that the borrower has access to the capital they need and the operational margin they need to run their business successfully. On the right, we'll look at sensitivities and credit analysis. That's how do banks look at these assets? How do we actually determine whether this is going to work or not? From our side, anyways. So we look at your strategy or your unique selling point, your USP. What is your business built on? Is it in the case, for example, like GigaClear, are you building a network in a rural area underpinned by government subsidies? Or are you more of a glide? Are you building a network which targets a specific niche that's underserved by other operators and competitors? What's the moat on which your business is being built? We look at the management team track record. Is this a business which is being run by people who've built these networks before, have got the track record, the experience, and many years in working in telecoms? Or is this a new entrepreneurial project? Different banks have different risk appetites, and different banks lend at different stages of the fiber growth curve. So it's quite important for the lender to understand just how much experience that management team has. And finally, we look at things like your competitor field and your overbuild risk. That's very much geography dependent. If we look at the UK, where only, as I mentioned, 10% of homes are covered, there's plenty of market share for plenty of operators to develop without competitors seeking to build on top of each other. But in other segments, in other geographies, that will be a consideration. What's protecting your business from competition on your network? So these are more qualitative topics we look at. On the quantitative side, we look at the revenue makeup, and that's quite granular, and these will be the things that we actually sensitize in the financial model. What is your pricing structure? How competitive are you? Are you at the top end of the pricing, at the bottom end of the pricing? Who are you going to generate your revenue from? Are you generating your revenue from sort of long-term 12, 18-month contracts? So, as an example, if we look at Virgin Media in the UK, if typically when you sign up to them, you sign up for a 12 or an 18-month contract, that's stable cash flows for a certain period of time. Or are you generating your revenues from monthly direct debits, which can be stopped at any time? What is the quality of your underlying customer? Are your revenues as your customer base sort of high net worth individuals in urban areas, or are you generating your revenues from students, which sort of come and go? Typically, we'll sensitize all of these revenue metrics in the model. And what we'll do is we'll say, right, well, if your average revenue per user, so the amount of revenue you expect to make per person within your business is X, well, let's cut that by 20%. does the proposition still work? Is it still viable? And we're not doing this because we're trying to sink the financial model, but we're just trying to understand. And again, as COVID has shown, well, things happen, and what impact those things have on your business. How resilient is your business to change or to adverse impacts? Construction capacity and resilience is probably one of the most important ones we look at. What is your capacity to roll out your network and to meet those targets? Typically operators will rely on third-party contractors to build their network for them. How reliable are those construction crews? Are they trained? Can they roll out the 5 or 10,000 homes per month that in your business model you forecast? And if not, how resilient is your business to a delay in construction? Again, coming back to COVID as an example, many construction crews self-isolate because one member is ill, so the entire crew goes down for a 2-week period. Well, what impact does that have on your rollout plans and thus your future revenues being generated? How resilient is your business to this? And then finally, your cost basis. And this comes back to maybe your strategy point. Are you building the network end to end, including the backhaul up front, in which case that's quite an expensive network to build up front. But over time, once the network is built, well, the maintenance costs are quite low. Or are you leasing the backhaul? Are you leasing the national backbone of your network and only building perhaps the last mile of the network? In which case, well, that's quite cheap to do. You're only paying to build the last mile, but it means that over time, you have recurring lease payments year in, year out, and over time that's expensive. So how are your costs structured? And again, we will sensitize that by either increasing them by say 10, 20% in the financial model, just to see what the impact of your cost basis has on the profitability on your business. So just to give you an idea of the kind of things that we as banks look at and how we sensitize them. And again, I would like to reiterate the point. We do this just to be able to more thoroughly understand how the business functions and its resilience to change or adverse effect. But at the end of the day, we seek to provide you with the capital you need for your business to grow. So conversation, sharing of information is always good up front. Just that way everyone knows how the transaction proceeds and what the expectations are in the years to come. To wrap up the presentation, I guess we'll look at the future of the digital infrastructure market. What are the themes that we see coming up? Well, firstly, and again, to bang on the drum, that's growth. We do expect the field to continue to grow. But what I mean by this as well is, as it continues to grow, those revenues start to get generated and you sort of reach more of a stable state. And that'll be the point where we think the segment becomes more of a utility as opposed to that growth stage it's at. And when an asset's at a utility stage, that will have its own implications on pricing. It'll have its own implications on the type of lenders and the type of investors that you see in the field. Consolidation within the data center space, well, I guess we're already seeing that. We're seeing sort of the big mega players. We're seeing what Silicon Valley come across. We're also seeing the Equinixes, the Digital Realties of this world acquiring left, right, and center. So I think in the data center space, we're already seeing that consolidation trend pick up. That's obviously going to continue. In the fiber space, there's still enough time and growth space, so to speak, for individual operators and entrepreneurs to build their networks. So I think we'll see consolidation, but probably a couple, 2-3 years away from the main spurt on that side of things. Long-term investors, this comes back to the liquidity flooding into the market. As the sector matures, we will start seeing the players change and we'll move away from venture capitalists and private equity more towards more institutional investors with a longer term view. So the pension funds and the insurance funds and so on and so forth. And then finally, but again, very importantly, regulation. as this segment becomes a utility, it will start to be regulated like a utility. Ensure there's competitive practices, ensure there's no price gouging for the consumer, and probably most topically, how is data being processed? Is data protection, being adequately addressed? And I guess we're seeing sort of the conflict, well, not conflict yet, but the differences in views between, for example, the European Commission, the European Union, and Silicon Valley. How is that going to play out, and how is that going to impact the segment going forward? Finalizing, a brief disclaimer. Please don't go and make investments in the segment without doing your own research and understanding the segment itself. This presentation sought to be informative and educational. I'm very happy to discuss it further, but yeah, that's up to you. And finally, my contact details. If you have any questions or further discussions you wish to have on either opportunities or just the segment in general, please do reach out. Thank you for having me.